If you hold Ripple XRP, we have some serious news to cover with you in this video. Because of what the Federal Reserve is doing right now, their dual mandate is starting to clash with each other. They have two jobs here. Okay, job number one is to keep employment at a maximum high so people all across America are able to work, and to keep inflation at low rates. And right now, unemployment is so low and inflation is so high that we're about to go into some crazy economic headwinds that's going to get even worse than where we are right now. And the CEO, a video that I have to play with you in this video, so watch all the way to the end, from the CEO of Chase, is talking about how you have 6 to 9 months to prepare before 2023 for this recession to get even worse. So with cryptocurrencies, the stock market crashing right now, the DXY, the US dollar index surging, I want to share with you in this video what I'm personally doing to prepare and what you should be doing to prepare as well too. So comment 777 if you're feeling blessed. Comment 777 if you're feeling bullish. You're ready to become a millionaire, because during recessions and even depressions, more millionaires and billionaires will be created than ever before. You know, right now I'm out here in Miami, Florida at my condo, actually in my home office here. You know, this is where I shoot these videos from, guys. You know, that's just the view from outside. So I'm gonna jump on the computer right here with you, and I got the microphone to sound crispy to show you what's going on in the markets right now. Let's run it. All right, my friends. So we have a lot to unpackage with you today in this video. On CoinMarketCap, there's 21,277 cryptocurrencies with a market cap of $920 billion. And everyone wants to know, where is the safe haven to put your money right now? When we look at the stock market crashing, we look at the entire cryptocurrency market crashing since November of 2021. Well, what is causing that? Let's discuss it. The effective federal funds rate is climbing in response to fight inflation, and people are pulling money out of the stock market. They're pulling money out of the cryptocurrency market. Big institutional investors and even retail investors are putting money into the US dollar currency index, the DXY, as a safe haven right now. And as we see US government bonds on the 10-year yield almost cracking 4%, just sitting at 3.943%, we need to talk about the yield curve on how that affects the markets. And then we're getting into the Fed's dual mandate, how that affects your portfolio, and then 5 ways to prepare for the recession to get worse and even you to potentially lose your job. So if you have a job right now, you are about as safe as Kanye West in his marriage, and Pete Davidson is the recession sending inflation texts to your bank account. So listen to this video if you want to prevent yourself from losing all of your spending power over the next few years, because inflation is not slowing down anytime soon. We're also going to talk about XRP. We're going to talk about some recent partnerships with Ripple in terms of central banking digital currencies. And also I want to discuss some important dates for the Ripple XRP SEC lawsuit that you need to pay attention to. And also on top of that, we're going to play this video right here of JP Morgan's Jamie Dimon, the CEO, warning US investors that we are going to tip into the worst of this recession in the next 6 to 9 months. Listen to this.
And this is serious stuff, okay? This is inflation, which obviously is, changing the effect of those numbers I just told you about. It's rates going up more than people expected already, and probably a little bit more from here. It's QT, which we've never had before. So therefore, the unknown effects, and you see it today in bond markets around the world and sovereign markets and people selling U.S. Treasury debt, and it's the war. And these are very, very serious things, which I think are likely to push the U.S. And the world. I mean, Europe is already in a recession, and they're likely to put U.S. in some kind of recession 6 to 9 months from now.
If we do see the U.S. go into recession, how severe do you expect it to be, and how long do you expect it could last?
Yeah, well, this is the thing no one ever really knows, right? You have a strong consumer going into it. Businesses are in pretty good shape, but they were amazingly resilient during COVID. Even the ones that had no government support and stuff like that. And I think governments did do a hell of a job. Can they recover? So we don't know. I mean, now you have to look at the range of outcomes. It can go from very mild to quite hard, and a lot will rely on what happens to this war. So I think to guess is hard. Be prepared. But the one guarantee, which we've been consistent about, is volatile markets. You're going to have volatile markets. You've already seen markets down quite a bit. No IPOs, very little high yield, bridge loans being hung and stuff like that, which is pretty typical, but it's still been orderly. I think it's possible you're going to see it be disorderly sometime in not too near future.
How do you think the Fed is doing in managing this whole situation?
Well, let me give them credit for what they did in COVID. And I hate to second guess people because I think it's easy for everyone to do. in hindsight, they waited too long and did too little, and QT should have started sooner, all that. But they're clearly catching up. They're clearly motivated to catch up, and from here, let's all wish them success and keep our fingers crossed that they manage to slow down the economy enough that doesn't, to cause whatever it is mild, and it's possible. I wouldn't take that off. I think that, like I said, the far more serious thing is this war, far more serious than the short-term effect of the economy and things like that.
So when we talk about inflation, it's basically undermining the basic American promise, which says if you work hard, you save money, you go to school, you get good grades, you graduate with a degree, and you work hard, you can get ahead in this economy. And then you log onto your Instagram and you see half-naked girls posting booty pics, making more money per day than you ever make in a year as a hardworking, blue-collar American man. That really makes you question your integrity and really makes you wonder if you should create an OnlyFans account. So needless to say, inflation is on everyone's mind right now. Prices are rising. It's up to 8.3%, and many things are costly right now. Gasoline prices up 25.6%. Food prices up 11.4%. Rent is up 6.7%. Health insurance up 24.3%. Oh my God, man. So if you walk into a grocery store expecting to buy a pack of cinnamon rolls, some Cinnabons on a discount, you can't get big and you can't get buff on a budget anymore, my boy. And with rent up 6.7%, what are you going to do to pay your landlord? Especially health insurance prices up 24.3%, the largest increase ever. So inflation is undermining the basic American promise, which says work hard, get ahead. It's trapping people in an endless loop, running fast, falling behind, unrelated to effort or input, like a hamster on a wheel chasing the cheese. Well, the brick of cheese continues to get smaller and smaller and smaller until eventually there's nothing left to run for. So we're looking at the S&P 500 right now being in this bear market. Now, if we were to compare this to 2008, not saying that this is going to happen, but we need to see a decisive break to the upside relatively soon to come back up to retest the 730-day or the 2-year moving average at the upper portion of this downward trending resistance right here, which would bring the S&P 500 roughly to 3,800 and some change right there. If it does not hold this moving average in red, which is the 200-day moving average, and we break to the downside, we could fall all the way back down to the 1,460-day moving average, which is the 4-year moving average, which would be roughly another 10 to 12% drop from where we are right now. Now, considering we're already down over 20% since December of 2021, a drop down to this moving average would put the S&P 500 at negative 30%. Now, if we were to compare this to the last two crashes in the past, well, the dot-com burst and the dot-com bubble was a 51% crash. The subprime mortgage crash was over 50% as well, too. So if we were to have another 50% crash, that would bring us back down to the lows that COVID took out. So Michael Burry from The Big Short is saying that we're about halfway there. Let me know what you guys think in the comments below. Because with the stock market being directly correlated now with the cryptocurrency market, because the wealthy diversify their income now across multiple different tech stocks and multiple different cryptocurrencies and altcoins, we tend to see the crypto market do the exact same thing. So right now we're down 73% in the cryptocurrency market cap. However, if we were to measure back from December of 2017, we dropped over 80%. So don't get too comfortable right now. There could be one final dip for the entire cryptocurrency market cap before we go back into a bullish market. So let's talk about what would cause the market to dip even lower and what you could do to prepare. Because when we look at the effective federal funds rate right here, sitting at right around 3 right now, we'll compare that to 1981 when it was above 19 right here. This is what's causing people to pull money out of the markets. When the Federal Reserve raises the federal funds rate, that affects how expensive it is to borrow money. And when it's more expensive to borrow money, less people are bullish on risk on assets like stock or cryptocurrencies. And so they pull money out of the markets and they put it into the DXY, which is the US dollar. And so that's why the dollar is surging right now. And we see US 10-year government bonds, the yield being up a drastic amount, the highest that it's been since back in 2007, 2008 during the subprime mortgage crash. Now, for reference, the chart that you can see on the screen right now is the yield curve. And this chart contains a couple different assets. So let's break them down quickly. The white in blue area that's massive right here is the rate of interest you receive for 2-year bonds when you buy them. The orange line is the rate for 5-year, the teal line is for 7-year government bonds, the yellow line is 10-year, the purple line is 30-year government bonds. So you can see it's very similar. However, as you can see, different maturing for bonds and different maturities pay different yields over time. If you purchased a 2-year bond in early 2021, you'd be earning 0.15% yield per year on your income. At the same time, if you purchased a 30-year bond in early 2021, you'd be earning 1.85% yield per year. So if you had $100,000 in a 30-year bond, you would be earning $1,850. Now, that's not enough to retire on. That's just simply enough to preserve your capital during times of inflation. So since 2001, the situation has changed drastically. If you purchased a 2-year bond, you're earning 3.56% yield per year. If you purchased a 30-year bond, you're earning 3.45% yield per year. So why would the yield on a 2-year bond be higher than the yield on a 30-year bond? Well, there's a few reasons here. Number one would be central bank funds rate risk. Number two would be the inflation risk. Number three would be credit risk. And number four would be the market risk. So from early 2021 until now, the Federal Reserve has raised the funds rate materially. This means that the government bonds must see their yield increase. So why would someone lend money to the government if you get more sticking your cash in a savings account? So if the yield in a savings account is higher than what the government can give you, that's a big problem for the government because they need your money so banks can give out loans. Secondly, inflation has picked up. This has been a result of supply shocks across the globe for commodities and services as shortages have cropped up and demand has been steady or increasing. Increases in the price of everyday goods has led short-term bonds to catch up to the yields of longer maturity bonds. Thirdly, the GDP has shrunk over the last 2 years, and the risk that the US government will be unable to pay back its debt through tax receipts and bond issuance rises. And finally, when stocks are outperforming bonds, institutional demand for stocks is higher, indicating that people are feeling good and they want to take a risk. They want to go to Vegas and they want to throw an extra 10K on the blackjack table or on the craps table, or they want to go and they want to spin the dial and get those lucky 777s to hit the mother trucking jackpot, cuz. So when bonds are outperforming stocks, it could be indicative that people would rather hold risk-free interest payment vehicles as opposed to equity in companies with worsening economic prospects. So this demand for bonds plays out across the yield curve, and demand for risk-free assets increases as the economic outlook worsens, meaning that the yield curve is indicative of how market participants think the market situation will play out over a given period of time. So if the yield for the 2-year bond is higher than the 10-year bond or the 30-year bond yield, the market participants through their purchases and sales are articulating that they expect the next 2 years to have more economic risks than the next 10 or 30. So a lot of people don't believe that this is going to be too long of a recession or too long of a market crash. In other words, they expect some sort of economic slowdown in the short term over the next 2 years. And this is extremely useful information for multiple types of day traders or crypto traders or stock traders or forex traders, because equities are tied to the economy. If rates are saying something about economic prospects, then it's smart to pay attention, as it may inform your asset selection process and your trading style. FX is ultimately tied with rates. If rates are moving, FX is sure to be impacted, and crypto has shown a high inverse correlation historically with the ease of money index. If rates are going up, then non-interest paying crypto becomes less attractive. So this brings me to the Fed's dual mandate on why this is important for your bank balance and for your crypto and your stock portfolio, because the Federal Reserve has two jobs here. Number one is keeping inflation low, and number two is to make sure a maximum number of people are employed in America, and this is known as the Fed's dual mandate. However, the Fed is being challenged in a way that it hasn't in over 40 years as it tries to do one part of its job, which hurts the other part of its job. So the dual mandates are starting to duel with each other. And why is that? Well, fighting inflation could lead to job cuts and layoffs, and that's why we need to talk about how you can prepare for potentially getting laid off from your job. Because when the Fed raises interest rates, it becomes more expensive for people and businesses to borrow money, so they buy less stuff and they invest less, and demand goes down, and that eventually brings prices down. Now, here's where another problem comes in, because when spending drops, companies aren't selling as much stuff
as they're not making that much money because consumers aren't buying as much. They tend to react by slowing down hiring or even laying off people. Bottom line is that raising interest rates can be really hard on jobs. When I used to work for a hospital and I scrubbed dishes for $7.25 an hour, I was at the lowest of the totem pole, so I was going to be the easiest to lay off. So I decided to quit that job before they ever had the chance to lay me off and go full time with a side business. So if you get value out of the videos like this, make sure you hit the subscribe button and you like this video so more people can see it when the YouTube algorithm pushes it. Because what's happening right now is very similar to the economic shock of the 1970s and 1980s. Very similar with the chair of the Federal Reserve, Paul Volcker, is comparable to Jerome Powell. He pushed interest rates higher. Rates peaked at about 20%. To give a little perspective, the current interest rate is around 3% right now, just a fraction of that. And the big result is an economic shock in a recession. The economy fell into a terrible recession at that time. Unemployment spiked to 11%, and people and politicians unleashed all kinds of wrath onto Volcker. But Volcker was totally focused on bringing inflation under control. And eventually it worked. Inflation did come down, but it took years of serious economic pain and millions of people lost their jobs. And just recently, the Chicago Federal Reserve President Charles Evans said the central bank is holding fast in its commitment to bring down inflation, even if it means people losing their jobs. So expect the unemployment rate to increase. So you have to prepare for the worst case scenario to take place, for the recession to get worse, and the potential of losing your job. So here's 5 things that you can do to prepare if you ever get laid off. Number 1 is to track your monthly expenses on a Google spreadsheet. Know where your income is going. Too many people, they go out to eat, they spend money on designer goods, they go out to the bars, and they just spend away on a credit card because this whole country is built off of debt and off of credit. And you're not spending money that you have, you're spending the bank's money, but they're going to come after you because they need their money more than ever before. So what you can't track, you can't measure, and what you can't measure, you can't manage, and what you can't manage, you can't grow. So if you want to grow your income, you need to know your monthly expenses. Number 2, build your emergency fund for a financial cushion in case you get laid off so you don't have to scramble. So many people live paycheck to paycheck and they have too much month at the end of the money and they wonder why they're broke. Number 3, get rid of liabilities and start investing in productive assets that produce you passive income and cash flow. And liabilities could be stuff like a television, video games, basically anything that isn't making you any money, like that crazy ex-girlfriend or boyfriend that wants to spend all of your money at Cheesecake Factory ordering the dessert every single night. Totally kidding. Shout out to Cheesecake Factory. I might be considered a liability. Number 4, start a side business. That could be affiliate marketing. It could be network marketing. It could be e-commerce, Etsy, drop shipping. Anything that you can focus on right now before you get laid off is always the preeminent strike, because you never want to wait for the worst case scenario to strike. Just like in a fight, you never wait for your opponent to hit you. You always want to strike first, strike fast, Cobra Kai. And number 5, subscribe to our daily video newsletter on runguys.com, because we provide you with helpful financial education and information like this to navigate these treacherous financial seas. And again, none of what we say is financial advice, so don't buy, don't sell anything that we talk about just because we talk about it. But if you want to see that, the link will be in the description below, and you can learn our number 1 way to earn passive income online with crypto and be entered in to win $100 as well too. Just turn the big bearish red button to bullish from red to green and put in your best email address and you'll be instantly subscribed. Plus, you're going to see our number 1 way to make passive income online. So those are the 5 ways. Let's dive into some news here really quick, because what's going to happen for the crypto market based on all of this stuff and you being prepared for them to raise rates even more? Well, which altcoins are we bullish on? And we've made this very clear on our channel that Ripple's XRP is one of those cryptocurrencies. However, there's a few things that need to take place first, and we're going to discuss those over the next few minutes in order for XRP to pass its all-time highs. So recent news shows that Ripple builds a new partnership in France and Sweden despite the crypto bear market. So Ripple is constantly working behind the scenes, and they're battling this lawsuit, juggling this at the exact same time. They formed new partnerships over in France and Sweden, marching into Europe despite the current wintry freeze marching through the crypto industry. Ripple signs deals for its on-demand liquidity system with Lemonway, a Paris-based regulation payments provider for online marketplaces, and Swedish money transfer provider Xbot, which is focused on remittance payments between Sweden and Thailand. RippleNet, the collection of banks and payment providers that have signed on to use Ripple's blockchain network for international payments, has clocked up payment volume of over $15 billion per year, the company said in a press release. While most crypto firms are struggling to stay afloat, Ripple appears to be in rude health. Now, I've never heard that example before, rude health, but it's absolutely disgusting and filthy how healthy they are, because they're promising to add some 300 plus staff members this year, a hiring goal on course to be achieved by the end of the year, according to Ripple's managing director for UK and Europe. Ripple is also circling assets up for grabs. I mean, who doesn't like to grab some assets? In the current Celsius Network bankruptcy auction, which includes the custody platform GK8. So it is not pleasant to see other companies in a tough situation in this market environment, but we do find ourselves growing fast, and also we are well funded, said Young in an interview. We are optimistically looking for some strategic investment opportunities. Although it's just one faucet of the financial system, payments covers a lot of different areas such as cross-border, domestic payments, and retail. A specific use case might mean relying on a particular crypto solution, hint hint, XRP. I certainly believe in the future where a lot of cryptocurrencies will be commonly used, as well as some central banking digital currencies, probably some stablecoins, and everything else in between. These different ways of carrying value will become interchangeable, and there will be different use cases for all of these. And if we look on Ripple's Twitter, last fall they announced their partnership with Bhutan's, I think that's how you say it, I barely know how to speak English, their central bank to pilot their CBDC. And so they're working nonstop with these partnerships for on-demand liquidity with France and in Sweden. Also being the founding members of the digital pound to support the design and implementation of a CBDC over in the United Kingdom. The foundation believes that a digital pound will underpin the UK's transition to an innovative digital economy and society, defining the future of money. Today, over 80% of central banks are actively exploring some form of sovereign-backed cryptocurrency, including central banking digital currencies, or CBDCs for short. The Bank of England has also recognized that evolving digital payment landscape brings the potential for faster, cheaper, sustainable, and more efficient payments with greater functionality. And which company are they going with? None other than Ripple. So why is the price of XRP still only right around 50 cents right now? We are sitting at a critical resistance in this 200-week moving average that you can see in red right here. If XRP breaks to the upside, we could shoot very quickly to 70 cents to retest the 730-day moving average, and eventually up to retest the highs of 2021 of nearly $2. Now everyone wants to know what would cause this. Well, it's the lawsuit with the Ripple versus SEC case. On October 18th, just in less than a week from right now, parties file all materials relating to oppositions to summary judgment motion temporarily under seal, including briefs, counterstatements, and supporting exhibits. That's October 18th. Now, October 20th, just 2 days after that, parties meet and confer to identify redactions sought by each side to the opposition briefs. October 24th, parties file public redacted versions of the opposition briefs, making only those provisional redactions requested by the parties during the meet and confer. November 15th, parties file summary judgment, reply briefs temporarily under seal. November 17th, parties meet under confer to identify redactions sought by each side to the reply briefs. November 21st, parties file public redaction versions of reply briefs, making only those provisional redaction requests by the parties during the meet and confer. December 9th of this year, parties file motions to seal all materials relating to the summary judgment motions, including briefs, statements and counterstatements, declarations, and supporting exhibits. Parties also file proposed redactions to such materials. In December 22nd, right before Christmas, parties file oppositions to motions to seal. So over the next few months, right before Christmas, we are about to see some massive things take place for XRP, and you better be prepared. So those of you that have been patient for XRP, you still have a little bit longer to wait, but once this lawsuit finishes up, I do feel XRP and Ripple is going to have a bright future. And you know what we're doing? We're backing up our truck all the way to the bank. We're grabbing the bags, packing them and stacking them, leaving no bags left behind, because we believe the spending power of the dollar based on inflation is going to continue to go down over time. Cryptocurrencies, the stock market, precious metals, commodities, real estate, land is going to continue to go up in value. That's the truth. And together, we're all going camping on the beaches of the moon. I will see you on the next video.